Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do, and so we begin. Today is Monday, July 1st, 2024, and today's episode will start by talking about the Japanese yen. It is collapsing currently against the dollar. The idea out there right now is that they might be engaging in currency manipulation to try to keep the yen from collapsing. We did see treasuries dump today, so it makes me curious if Japan really is doing this and dumping treasuries. That's why the treasury market is collapsing today, and yet it's not really helping the value of the yen. So interesting things going on there. It'll be really interesting to see how that plays out. I just wanted to note that, a lot of people, including myself, talk about how Japan is the largest foreign holder of U.S. debt, holding about almost $1.2 trillion of treasuries. But the total U.S. Treasury debt is 33 trillion. So Japan only represents 3.5% of the Treasury debt, and so even if they were to sell all of their debt, it would cause chaos for a little bit. But I don't know. I'm actually personally not all that worried about that. Before we get into the third subject, I just want to go over today's data drops. The PMI coming out still expanding here, but the ISM manufacturing showing more of a slowdown. Funny enough, both of these measure a pretty similar thing in a different way, but so not much to see here. And construction spending was expected to drop by 1/10, and it dropped by 4/10 to negative 0.1. Also tomorrow, look out at 10 a.m. for JOLTS, the job openings that can affect markets. And Friday is the really big one, the unemployment report. The last reading of this and the expected for this for last month, I guess that's for June, is expected to be flat at 4%, so it'll be really interesting to see what happens there. Now moving on to the main subject of today, I want to talk about credit card delinquencies and how you may have been seeing this in the news on other people's channels, in headlines and all of that. And I'm going to state that I believe that it is slightly overhyped. I'm going to go into the reasons why, and I'm just going to state unemployment really leads everything, and that I don't think we need to worry about credit card delinquencies right now. So the chart that I'm talking about is U.S. credit card accounts delinquent by 90 or more days. This is on Y charts. This current view of it I got from Gareth Soloway's Verified Investing. Other news sources are talking about this number here, 10.7%, and noting how we haven't seen that rate since the Great Financial Crisis. The most important thing to note here is that this is all U.S. credit card accounts. I'll be referencing that later. I also just want to note that I tried to dig deeper to get a longer term chart of this, or data somewhere. The data appears to only go back to 1999, and so it would be great to have a further history to see how it relates to further back, but that's not really relevant. The main thing is all U.S. credit cards and 10.7%, and we haven't seen this supposedly since the Great Financial Crisis. And the idea here is like trying to get people to, it's sort of clickbait, and I'll show you why. Sorry to jump around a little bit. I'm gonna go back to TLT dumping just to show the chart before we get into the credit card stuff. So I just wanted to note that on TLT today we actually closed right at this trend line, and so this could actually hold up TLT. This could be a bottom here. I don't know what's going to happen. It looks, from a charting perspective, most likely it will go sort of where my mouse is, sideways, before breaking higher or lower. I don't really know what's going on here. And another view of the yield, which is the upside down chart of TLT, we hit this trend line perfectly, and so my feeling is about this is that most likely it will be rejected, or at least there'll be a fight here at this line, but we'll see about that. On to the credit card delinquency material. First chart I actually want to bring up is high yield spread between treasuries and high yield corporate. I believe it's BAA rated. Now, when this goes up, that means that the economy believes that there's more risk involved with lower credit scores, and so you have to pay more if you want to borrow money, and that's what makes this thing go up. And as you can see in the Great Financial Crisis, this thing went absolutely parabolic. And again, when things are getting shaky, there were problems. It wasn't officially a recession in 2011, but you had a lot of markets collapsing there. When this is going up, there's problems. And so first of all, I just want to point out that right now credit spreads are pretty darn low, and they don't look like they want to go anywhere higher anytime soon. And even if they do go higher, it's like, if you look back in this chart, there's lots of times where it can go up and down, up and down, up and down without going through a major recession or anything like that. And so, overall credit spread between, high yield stuff and treasuries, it being so low, it says that, there's just not, the market's not seeing very high risk with credit in general. Sorry, I said that wrong. This is the difference between treasuries and BB rated corporate bonds. The next chart, this is between BAA corporate and treasury spread. So it's just another way to see the spread between treasuries and higher yield corporate. When it's low, it means that people aren't, they can lend money at a lower rate compared to the rate you can get for treasuries because they're not worried about delinquencies. And when this goes up, it means they have to charge more to lend money. That's how that generally works. And again, right, like you can see with this chart here, this one goes back a long time, all the way back to 1920. And so you can see when there were major problems, the credit spread really spikes. And we're not anywhere near anything like that for the moment. I'm not saying that it can't happen tomorrow, that the rates can't just start spiking in the next few months, but we're not there yet in terms of yield spread. So getting directly back to delinquency rates on credit card loans. If you go to the Fred website, I got confused about this because this is showing all commercial banks, credit card loan delinquency. When I look it up, I'm not getting the same numbers as you saw in that chart that I just showed you. In fact, we're currently at only 3.23%, whereas that other chart I showed you shows is above 7.5% since 2016. So why is there such a big difference here? My understanding is that these are commercial bank credit cards, so like the big credit cards from commercial banks. Not all credit cards come from commercial banks. They can come from retail stores. They can come from all sorts of other places. And so that 10% that you're seeing involves all of those accounts. Your TGA Max credit card that you got because you wanted to save 10% one day. And again, it's like number of cards that are in delinquency, and it makes me wonder if these are just a bunch of little ones that have that much debt. And it really could be that way if you dig deeper into what's going on with these. So looking at delinquency rates on credit cards makes me wonder, well, what about in other areas? This chart, I went down a little bit of a rabbit hole today. This Fred chart is delinquency rate on single family residential mortgages. It's like all-time low. It's like nothing to see here, folks. Then we have another one on commercial real estate loans. You're hearing about real estate being so bad and everything right now, everything's shutting down, and the rate's only 1.25%. We're at like record lows. The credit card thing is of its own. We're not seeing this across the board. All consumer loans, all commercial banks, that has gone up recently, But, you know, we've never even seen it overall this low. Since 2012. Before 2012, delinquency rates on all consumer loans never went as low as they still are today, even though they spiked quite a bit higher recently. When you really dive a little deeper into Fred, they have a lot of amazing articles and comparative charts and suggestions for more charts and articles. Reading through this stuff is really fascinating. But this last version of this chart here shows all of these together on top of each other. Residential mortgage delinquencies, credit card loan delinquencies, lease financing receivable delinquencies, and business loan delinquencies. And as you can see here, where we are today is at the very end of this chart. And yeah, credit card loans have gone up a bit, but again, lower than normal since the 90s still. And so is this an alarm bell? There are alarm bells going off. There are plenty of alarm bells going off. This isn't one of them. The source of that first chart showing nearly 11% of credit card delinquencies came from the New York Fed. And so I went there and found the documents that go over that and lots more information. And I learned a number of things I want to share with you. So first of all, total debt balance and its composition, trillions of dollars. This is where people's debt is. The orange is mortgages. That's a huge amount of debt. HE revolving, not sure what that is. No, I don't know what it is. Auto loans, they've gotten bigger, but again, tiny piece of pie compared to mortgages. But auto loans, also much greater than the credit card loans. And I'm going to remind you that, these credit card loans are not just composed of, TJ Maxx credit cards and stuff like that, but, commercial bank loans too. And most of this is not in delinquency. I would say the majority of this is not in delinquency. I would suggest that, and I don't know this for sure, but I would guess that the majority of the credit card debt in terms of dollar amount is probably not in delinquency. I'm not 100% sure on that, but I'm assuming that is likely to be true. Even if it's not, credit card debt doesn't represent a huge amount of the overall consumer debt. Student loan debt by itself is almost double credit card debt there, and then other debt is in gray there. All in all, if all of these other types of debt are doing fine, and there's a little spike in credit card loans, yeah, it is a tiny warning bell, but not a huge one. From this same document, number of accounts by loan type. So you can see credit card loans since 2017, the number of cards has been really spiking. And so, maybe a lot of these delinquent cards are, only have $10 on them or something like that. But yeah, going through these different reports is very interesting. Credit score, they divide it by age. They show all of the things to do with credit. But, the main thing that I wanted to share with that was simply the fact that I don't think that number you see on that first chart is as much of a big deal as some people might think it is. Yeah, so here it is. They took the blue line and they took away all the other lines to get you that chart that you saw. The blue line is credit card delinquencies, which, yes, it has spiked up to levels, not seen since the financial crisis. But, student loan delinquencies have been skyrocketing, and now they're almost to zero. Mortgage have never been lower. HE revolving, very low. Auto loan, basically going flat for the past 25 years. So, careful where you get your information and what people can do with it. It's easy to get manipulated by YouTubers with crystal balls and stuff like that. So that's the long and the short of it regarding the credit card debt. You know, boy who cried wolf or whatever. But main point is simply that, you know, the real thing that will kick off more delinquencies in mortgages, in auto loans, in, you know, just the core, you know, commercial bank credit card loans is unemployment. And, you know, that's been going up. This Friday is going to be a big day for me to see what is going on. I think that's the biggest main leading indicator that we need to keep track of to see where things might go. Moving on to the charts, S&P 500 still just going straight sideways. I mentioned it was going sideways as soon as it started going sideways, and I've been correct about that so far. Fear and greed index at solidly at neutral. We don't know where to go here. You know, maybe JOLTS will give us a jolt of information. And then, yeah, the big one is Friday for this month, the unemployment report. And that's all I have for today's show. I hope you enjoyed. Thank you for watching. Robschild.